Hi, this is Abhinav, and I welcome you. In the previous video, I had covered about understanding 401k plans and it's the taxation aspects. In this video, I'm taking up individual retirement plans and the taxation aspects in US. The taxation of IRA plans in India, I will take up in a separate video, so stay tuned. Okay, so let us start. I made a few pointers. So basically, what are IRAs? IRAs are similar to 401ks only. Now, 401ks are basically employer-employee plans, right? Like if you are an Indian, you will understand it this way that 401k is like employer provident fund (EPF), and IRA is like public provident fund (PPF), right? So IRA is like a tax deferred investment account in US that helps you save for your retirement, and it's basically mostly it's two types. One is traditional IRA and Roth IRA. They have some differences which I will take up. Who can contribute? Now anyone can contribute, right? So even a self-employed person can contribute. Anyone who has earned income from wages or self-employment, right? So 401k, only that person can contribute who is in a job with a particular employer. But IRA, anyone can contribute irrespective of age. There is no age limit also for contribution. The only requirement is that you must have had earned income from the wages. If you don't have earned income, for example, if you have income only from for dividend interest, right, then you cannot contribute, right? And you can only contribute up to the earned income, right? Okay, so what is the maximum contribution that you can do, which can be deducted, right? See, you can contribute any amount, but only a certain till a certain amount can be deducted, and that is where there is a the magic of the IRA comes in, right? That you can, it's a basically pre-tax contribution. That means you contribute, it gets deducted from your income. So whatever the amount that gets deducted is basically you allow it to grow in a tax deferred that tax deferred way, right, till you take the withdrawal, right? So that's the big significant benefit. So basically IRS has restricted the maximum contribution that a person can make, which can be deductible. You can make a non-deductible contribution over and above this deductible contribution. For this you have to file a certain form, which will come to, but otherwise this is the basic limit where you get this benefit of a deduction. What is the limit? It is $7,000 per year. Now this is 2024 limit. This limit will adjust every year. It will increase every year. It's inflation adjustable, right? So it is $7,000 per year. Now $8,000 if you are 50 years or older. So for less than 50 years age, it is $7,000. $8,000 if 50 years or older. This is the maximum contribution. Now this is the combined contribution limit for Roth or traditional. Whatever you want to invest, the deductible portion, this is the limit. Now contribution limits per spouse and can be claimed jointly on tax return. Excess contribution penalty of 6%. So basically, for two spouses who are filing a joint return, this particular limit applies individual person, right? So 7,000, 7,000. Both husband and wife can take 7,000, 7,000, right? Both spouses can take and claim on the joint return. If you make excess contribution, then there is a penalty of 6%, right? Now, for IRA, there are phase out rules based on modified adjusted gross income. If any of the spouse is eligible to contribute to an employer plan, for example, a 401k plan, right? So now, for IRA, traditional IRA, so I meant here traditional IRA. Traditional IRA, there is a phase out rule that yes, you can contribute up to $7,000 and or $8,000, but if your if any of the spouses is eligible to contribute for an employer plan like 401k, right? For example, husband is in a job where there's no 401k, wife is in a job where she can opt for a 401k but she doesn't opt for, even then there are phase out rules. Like I think somewhere around 70 $80,000 there is a phase out. That means beyond that, if the income is there, modified adjusted maggie, beyond that, if that income is there, then you cannot contribute, right, to a traditional IRA. So that is a very important rule that needs to be kept in mind. It need not be that the person contributes to a 401k, but even if one of the spouses is eligible also, then it gets restricted. So that those limits need to be kept in mind, right? Now for Roth, there are separate income based phase out rules. Beyond a certain income, you cannot contribute to a Roth IRA, right? Okay. Now, then there are certain provisions for spousal contribution. Now, one spouse has earned income, right, which qualifies for investment. So, as we discussed earlier, you can only contribute if you have an earned income from wages or self-employment. So, take a case of a husband and wife. Husband is into a job, and he is earning like 10,000, yeah, $10,000, right? So he's having that earned income from wages, and he can contribute up to $7,000. But wife doesn't have any particular income, right? Wife doesn't have an income. In that case, what the husband is doing is that it is called spousal contribution rule. That means out of $10,000, 7,000 is in his name, and $3,000 can go in wife's name. So wife can also apply, right? For that, I think there is a requirement of filing a joint return, right? And that $3,000 can be invested in the wife's name, right? So that a beneficial rule is available. Okay. Now, contribution is deducted from income. It's a pre-tax contribution. Roth contributions are not deductible, right? Roth are basically post-tax. You contribute from post-tax money. So basically, they are not deductible, right? But the withdrawal is tax-free for Roth. Now, non-deductible contributions can also be made, as I discussed earlier. If you want to contribute anything above $7,000, right, you can contribute, no problem. But you need to file Form 8606, right? And it says advisable, if you want to contribute, you should contribute in Roth, because when you contribute in Roth, then what happens is the withdrawal is tax free, right? However, if those who are planning to return back to India, uh, then Roth is not advisable because of the complicated taxation of Roth in India, right? You may explore other options, but if you want to contribute above over and above 7,000 as a non-deductible contribution, you must file Form 8606. Otherwise, what happens is at the time of withdrawal, everything gets taxable. If you file 8606, then to the extent that you file for 8606, the contribution at the time of withdrawal will not be taxable because it's a non-deductible contribution at the time of making the payment. So that needs to be kept in mind. And this Form 8606, all these forms need to be carefully preserved till the time of withdrawal, because withdrawal can be like 20, 30 years down the line. So you need to preserve the filings if you are making non-deductible contributions. Okay, you can contribute to multiple IRAs subject to the overall contribution. So if you can have multiple accounts, so right, it's not like in India you have the PPF account, so one person can only have one PPF account. Here you can have multiple IRAs with like different brokerages, and you can all the contribution to the IRAs together in aggregate should not cross the maximum deductible contribution per year. Otherwise, there is an excess contribution penalty that applies. You can contribute to Roth over and above the IRA. Over and above the IRA, you can contribute to Roth. If the income based phase out rules do not apply to you, if your income is below the phase out rule for Roth, then you can consider anything above the deductible limit for 401k. You can explore Roth IRA, right? It's good from an overall estate planning perspective also, because the withdrawal will be tax free to the beneficiaries. Now, last date for making the contribution, like in the previous video we discussed about 401k, it's December 15th. However, in IRA, it is April 15th of the year following the calendar year. So you get like 3.5 months of post year tax planning window you get, that you can still, after the tax year is closed, you can decide that I want to contribute more into the IRA and save more tax. But there is no extension. So if you opt for a extension to your tax return, you cannot extend the contribution. The timeline for making the contribution is April 15th only, right? So you need to keep in mind. Now, coming to taxation aspects, now traditional IRA and Roth IRA, the taxation aspect is different, right? Now, traditional IRA, the withdrawals are fully taxable, right? In US at graduated rates. Now, at graduated rates means the slab rates, right? It's fully taxable. Whatever withdrawal you are making, it is fully taxable. Now there are separate tax rules for non-resident aliens. So for example, you have returned back to India, right? And at the time of you are in India, you qualify as you are not a US citizen or a green card holder. You qualify as a non-resident alien for US tax law. Then the withdrawal will be taxable to you, but there is a separate tax rule. What the tax rule is, in case of non-resident alien, I'll make a separate video on taxation of non-resident aliens, detailed video. But basically, what the rule is that the contributions, there are two components of the withdrawal. One is the contribution that you had made, second is the income on the contributions. So the contributions will be treated as effectively connected income, ECI, and it will be taxable at graduated rates, similar to in the US for normal US citizens. However, the interest income, the dividend income that you get from the investment of that money, that will be taxable at flat 30%, right? So that kind of a calculation that you will need to do. The broker will always deduct a 30% flat, or if there is a lower treaty rate that between the country of your residence and the US, if a lower treaty rate is there, uh, then you can opt for a lower treaty rate. For example, for dividend in India, you can claim, instead of the 30%, you can claim 25% withholding and 25% tax. So that you can provide the W8BEN, that document you can provide to the IRA provider, and he can do that. So there are separate tax rules for non-resident aliens. For US citizens, US residents, withdrawals are fully taxable at graduated rates. If you make early withdrawal is what? Before age 59.5, if you are making the withdrawal, then there is an early withdrawal of penalty of 10%, which is tax only. IRS calls it additional tax of 10% that will be chargeable. Now, for Roth IRA, it is a bit different. In Roth, the withdrawals of the contributions can be done anytime, right? So you make the contributions, and contributions are post tax, right? You do not get deduction for Roth IRA contributions. You can do a withdrawal of the Roth IRA contribution anytime, and they are tax free, right? Totally tax free in US. Withdrawal of earnings also is tax free, provided there are two conditions. It should be done after 5 year period from your investment, after 5 years from your investment, and age 59.5. Right? If any of the two conditions you don't fulfill, then it will be taxable, and the penalty of 10% will be applicable. Right? So this is basically the taxation of traditional IRA and Roth IRA on withdrawal. Right? Okay, rollover to another IRA can be made. So, for example, you hold IRA with a brokerage A, and you are moving to a brokerage B. You can do it. Do a trustee to trustee rollover, which is basically called a direct rollover, and you can do it unlimited. Such rollovers in any tax year, and totally tax free. It's non-taxable event. And in case of an indirect rollover you are doing, for example, indirect rollover is that brokerage A issues you a check of the total fund value, and within 60 days you have to uh, uh, give it to the new brokerage, new IRA provider. If you do it within 60 days, then it is a non-taxable event, and only one such indirect rollover is allowed. Now, roll over to Roth IRA to the extent of deductible contribution, and there is a 20% withholding tax in case of indirect rollovers, right? So that you need to keep in mind. Roll over to a Roth IRA to the extent of deductible contributions, right? So if you have like $10,000 in your IRA, 8,000 is basically deductible, which were basically you had deducted the contribution from your tax returns, and 2,000 are non-deductible, for which you had filed form 8606. So to the extent of deductible contributions, that is $8,000, the rollover to the Roth IRA will be taxable in the year in which you are making the rollover. So that you need to keep in mind. Then, in case of IRA, you need to take a required minimum distribution from age 73, right? However, it's basically only applicable for traditional IRA. For Roth, there is no such requirement of taking a required minimum distribution, right? So this is it. This is about some pointers on IRA, individual retirement plans. If you're planning to move to US, then these these understanding you need to have, and the taxation aspects. If you have any queries, any thought on this, do share in the comment section and I will help you. Thank you so much for watching this video. Thank you so much.